Hi ladies and gents, welcome to this podcast where I'm going to be looking at depreciation and the disposal of non-current assets. What this links to is what we've been doing so far, where we've looked at reducing balance depreciation, straight line depreciation, and we've also looked at the valuation method of depreciation. Okay, first example we're going to look at, we're going to dispose of a vehicle on the 1st of April 2016 that was purchased on the 1st of January 2014. And this company has a financial year end of the 31st of December. First thing you need to do with any depreciation question, particularly involving disposal, have a check about the depreciation policy. And this one, quite a common depreciation policy, is that they are going to do a full year's depreciation in the year of purchase and none in the year of disposal. And ICARN is going to depreciate the assets at 20% per year using the straight line method. So what this little bit here means, that means that the year they purchased in, 2014, there will be a full year's depreciation, even if they purchased it halfway through the year. They're going to dispose of it in 2016, so there'll also be a full year's depreciation for 2015, but they're going to ignore any depreciation in the year of disposal, which is 2016. First thing we need to do is straight line method, so it's easy. We need to calculate a full year's depreciation. So that'll just be $16,000 times 20, and that comes to hopefully $3,200 per year. So for each of the years that this asset is owned before the year of sale, we're going to include an extra $3,200 of depreciation. Looking at the account, if you remember, the motor vehicle account, well, that doesn't change unless we buy or sell an asset. So far, they have bought the asset, balance carried forward, balance brought forward, a balance brought forward on the 1st of the 1st, 2016 of $16,000. But what we do need to do is the depreciation account. And again, remember, because depreciation is really profit put on one side, to allow for the decline in the value of the assets. We don't know what the decline in that value of the assets is exactly until we actually dispose of it. For the depreciation account, in the first year, 31st of the 12th, 2014, we increased the depreciation by $3,200, carry forward and bring forward $3,200, and then in the second year, we put in the second lot of $3,200 depreciation, which will appear as an expense in the income statement. And therefore, at the start of 2016, the total depreciation in the books is $6,400. Right, we've now come to the disposal part. So for the disposal part, okay, we're going to dispose of the asset on the 1st of April, so 2016. Okay, and what we do, we send that $16,000 in its entirety to the disposal account. So we're going to show you the disposal account down at the bottom in just a moment. Make those red so we can you know what's new. Okay, so what we can see now down here in the disposal account is that $16,000 of the value of the original cost of the motor vehicle is now a debit entry. So if you look at that, it's just straightforward double entry. We've credited the motor vehicles account, debited the disposal account. And we need to do the same thing with the depreciation account. We need to debit the depreciation account because we need to remove all the depreciation to do with this motor vehicle. We need to therefore credit the motor vehicle disposal account with $6,400. And then we're told up here that it was sold for $4,000. So it's going to be a debit entry in the bank, and therefore it needs to be a credit entry in the disposal account. And now we balance off the account. So when we balance off the account, it's going to balance off at $16,000 because in this case, the debit side is bigger than the credit side. And therefore, the amount that will appear in the income statement, and it will appear in the income statement as a debit entry because it's a credit entry in the disposal account, and a debit entry in the income statement as an expense, is $5,600. If you think about the logic of that, The logic of that makes sense. We paid 16,000 for it. We've already reduced our profits by 6,400. So we thought this asset was going to be worth 9,600, but we only got $4,000 for it, and therefore we've got an expense of $5,600 that we haven't allowed for in previous years. Right, what I want you to do there is to very quickly pause the video and have a go at the first example that I've done for you on the worksheet. Okay, welcome back. What we're going to be looking at now is the same topic, but this time what we need to look at is where we're using reducing balance depreciation. So it's slightly different. Okay, in this case here, we've got the same guy, Icon, is going to dispose of a machine for $8,000 on the 1st of April 2016, and he purchased the machine on 1st of January 2014, and he's going to charge a full year's depreciation in the year of purchase and on the year of disposal. So with reducing balance, the first thing is it's slightly more complicated just calculating the depreciation for each year. For the first year, for the year ending 31st December 2014, had an opening carrying amount of 20,000. It's going to do 50% depreciation in the first year. So that means it's going to send $10,000 worth of depreciation to the income statement. The carrying amount at the end of the first year is going to be $10,000. Second year, he's got an opening carrying amount of 10,000. 50% depreciation, so there's going to be 5,000 depreciation in the income statement, and therefore the closing carrying amount is going to be $5,000. Machinery account, no different to what we've done in the past. So 20,000 was the original purchase, balance carry forward, balance brought forward, balance carry forward again at the end of the second year, balance brought forward of 20,000, and then we're going to send the whole of that 20,000 to the disposal account on the disposal date, which is the 1st of April. So the 1st to the 4th, 2016, disposal, and that's going to be $20,000. Hopefully, that will appear in our disposal account. Okay, the depreciation, we've got 15,000 depreciation at the start of the year. That all goes into the disposal account. So we're going to debit the depreciation account for 6,400. We're not, we're going to do it for 15,000. Okay, we're going to credit the disposal account for 15,000. And bank, well, from the bank, we found that he got, it's not scrolling up, 8,000, I'm sure it's 8,000. $8,000 paid into the bank. So debit bank, credit disposal account, just straightforward double entry again. And this time the credit side is bigger than the debit side because the credit side totals 23,000. So therefore we need to make, to balance the account off, we need to make a debit entry of $3,000. Because it's a debit entry in the disposal account, we're going to make a credit entry straight into the income statement. And the credit entry in the income statement is going to be added on to the gross profit. So whatever the gross profit for this company is, we're then going to add $3,000 on. If we think about the logic of this, we paid $20,000 for the vehicle. We put on one side from profit already $15,000. So that reduced our profit in previous years, and we also got $8,000 for the actual asset. So we actually, including the depreciation, what we got had $3,000 more than we actually paid for it. So we got more back than we were expecting. Right, second question for you to have a go at. Okay, reducing balance depreciation. Good luck with that, and I hope you enjoy this topic. Thank you very much. Don't forget to email the work to me, and don't forget to fill in the assessment as to whether you think you can do this topic or not. Bye-bye.